Imagine you're watching a basketball game. The ball bounces on the court, and every time it hits the floor, it rebounds back up. Now, think of the floor as support and the ceiling as resistance. In the stock market, prices behave in a very similar way. They fall until they hit a level where buyers see value and step in, causing the price to bounce back up that support. They rise until they hit a level where sellers see a great price to cash out, causing the price to reverse back down. That's resistance. Understanding how to read these levels is arguably the single most important skill you can develop. As a trader, it's the purest form of supply and demand visualized on a chart. While other indicators lag, support and resistance show you the real-time battle between bulls and bears. In this guide, we're going to move beyond just drawing lines and dive into the psychology behind these levels, how to identify the most significant zones, and how to use them to dramatically improve your trading accuracy and risk management. Let's start with the most basic and powerful form: horizontal support and resistance. These are not thin, precise lines, but rather zones or areas on the chart where the price has historically reversed direction. To find a resistance level, look for a price area where the stock has tried and failed to break through on multiple occasions, creating a series of two or more distinct peaks. Each time the price visits this zone, sellers become active, believing it's overvalued, and overwhelm the buyers. To find a support level, look for a price area where the stock has found a floor, bouncing off it multiple times and creating a series of two or more distinct troughs. At this level, buyers perceive the stock as a bargain and step in with enough force to overcome the sellers. The more times the price has tested and respected a specific level, the more significant and reliable it becomes. A level that has held firm on 5 separate tests is far more important than one that has only been tested twice. These historical price points act as collective memory for the market, creating self-fulfilling prophecies as traders around the world watch and act on the same levels. Now, here's a critical concept that most beginners miss: the role reversal principle. Once a significant support level is decisively broken, it often flips and becomes a new resistance level. Conversely, when a major resistance level is convincingly broken, it frequently transforms into a new support level. Why does this happen? It's all about trapped traders. Let's say a stock has bounced off a support level at $50 several times. Many traders have bought at that level. When the price finally crashes through $50, all those buyers are now sitting on losing positions. If the price later rallies back to $50, those trapped buyers are just waiting to break even and sell their positions, creating a wall of supply that acts as resistance. The same psychology works in reverse for a broken resistance level. This flipped level becomes one of the most powerful areas to watch for your next trade, as the emotional intensity of these trapped traders creates a very predictable reaction. While horizontal levels are static, there's another crucial type of support and resistance that is dynamic, meaning it moves over time. These are trend lines and moving averages. An upward trend line is drawn by connecting a series of higher lows. This line acts as dynamic support in an uptrend. As long as the price stays above this rising line, the trend is intact. A break below it is a warning sign that the uptrend may be weakening. Similarly, a downward trend line connects a series of lower highs and acts as dynamic resistance in a downtrend. Moving averages, particularly the 20, 50, and 200 period EMA letters, also serve as dynamic support in uptrends and dynamic resistance in downtrends. The price will often pull back to a key moving average, find buyers, and then continue its trend. The advantage of dynamic levels is that they adapt to the market, giving you a moving floor or ceiling that defines the trend's slope and health. The true test of any support or resistance level is the breakout. This is when the price gathers enough momentum to push through a key level. However, this is also where traders fall into the trap of false breakouts or fakeouts. A false breakout occurs when the price briefly pushes above resistance or below support, tricking traders into entering, only to reverse sharply and trap them on the wrong side of the trade. So how do you tell a real breakout from a fakeout? The answer lies in confirmation. The most reliable breakouts close decisively beyond the level. Don't just look at the intraday spike. Wait for the daily or weekly candle to close on the other side of the level. The second and most important factor is volume. A genuine breakout should be accompanied by a significant surge in volume. This shows strong conviction from large institutions, not just a minor push by retail traders. A low-volume breakout is a major red flag. Furthermore, a breakout that can't hold and quickly falls back into the prior range is a classic false breakout signal. Patience is key. It is often safer to wait for a successful retest of the broken level where the old resistance becomes new support and holds before entering a trade. This confirmation saves you from countless whipsaws and failed moves. Remember, this is educational content and not financial advice. Trading carries a high level of risk, and you can lose more than your initial deposit. It is not suitable for all investors. Please ensure you fully understand the risks involved and seek independent advice if necessary. If this deep dive into the core of chart analysis has been helpful, please support the channel by liking this video and subscribing for more content that builds your trading confidence. Now, I'd love to hear from you. What is the most challenging aspect of drawing support and resistance levels for you? Let me know in the comments below.